The morning star pattern is a significant indicator in the trading world, signaling a potential bullish reversal after a downtrend. It consists of three key candlesticks. The first is a long bearish candle, followed by a small bodied candle that gaps down from the first candle, and the third is a long bullish candle that closes within the body of the first candle, but well into the loss range of the first session, indicating a shift in momentum from sellers to buyers. Understanding and recognizing the morning star pattern is crucial for traders as it can help them make informed decisions about entering a trade. It is advisable for traders to practice identifying this pattern in different trading scenarios and environments to hone their skills in technical analysis. To conclude, in the dynamic world of trading, continuous learning and adaptability are essential. The financial market is ever-changing, and strategies that worked yesterday may not work tomorrow. By staying informed about patterns like the morning star and adapting trading strategies accordingly, traders can improve their chances of success in the market. Emphasizing the importance of ongoing education and flexibility in trading approaches will enable traders to navigate market complexities more effectively. Candlestick patterns play a crucial role in financial market analysis. These patterns are formed by the movement of prices on a chart and are used by traders and investors to forecast future market movements. Each pattern provides visual cues about market sentiment and potential direction changes in prices, making them an essential tool for making informed trading decisions. The evening star pattern stands out as a classic bearish reversal pattern, signaling a potential downturn after an uptrend. This pattern is easily identifiable by its three-candle sequence. The sequence starts with a long bullish candle, indicating strong buying pressure. This is followed by a smaller candle, which denotes a reduction in buying pressure and typically opens higher than the previous close, indicating the start of indecision or a slowdown in momentum. The third candle in the sequence is a long bearish candle, which opens lower than the second candle and moves well into the body of the first candle, conclusively signaling that sellers have taken control and a potential reversal in the uptrend could be imminent. Understanding the evening star pattern is crucial for traders and investors as it helps in recognizing the early signs of a potential change in market direction. This knowledge can be instrumental in making strategic decisions, such as entering or exiting positions to capitalize on anticipated market movements. The evening star candlestick pattern is a technical analysis indicator that suggests a potential bearish reversal in the market. It typically occurs at the end of an uptrend, signaling that the momentum may be shifting from the buyers to the sellers. This pattern is made up of three candles. The first is a large bullish candle, indicative of strong buying pressure. The second is a smaller candle, which gaps higher than the first one, showing a deceleration in the upward momentum. This candle can be either bullish or bearish and often appears as a star, hence the name. The third candle is a large bearish one that closes well into the body of the first candle, confirming the potential for a downward reversal. Visualizing the evening star pattern can be quite impactful. Imagine the market has been climbing, represented by a series of long upward candles. Suddenly, a small candle appears, either not moving much higher or even showing a small decline, signaling hesitation among the buyers. Following this, a large downward candle emerges, eating into the gains of the first candle. This visual starkly contrasts with the prior uptrend and suggests that the sellers are taking control. In various market scenarios, the evening star pattern can serve as a caution signal. For instance, in a rapidly rising stock market or during a strong rally in commodities, spotting an evening star pattern could warn investors that it might be time to secure profits or consider hedging positions to mitigate potential losses if the trend reverses. Understanding and recognizing the evening star pattern is valuable for traders and investors. It provides a signal to reassess positions in anticipation of a possible trend reversal, highlighting the dynamic and constantly changing nature of financial markets. By paying attention to such patterns, investors and traders can make more informed decisions, managing risks with a more strategic approach. The evening star is a bearish reversal pattern that appears at the end of an uptrend, signaling a potential reversal to a downtrend. It consists of 3 candles. The first candle is a large bullish candle, indicating the existing strength of the uptrend. The second is a smaller candle, which may be bullish or bearish or even a doji. A candle with a relatively small body, indicating a decrease in the buyer's momentum and uncertainty in the market. This candle gaps above the previous candle's close, creating a visual separation. The third candle is a large bearish candle that closes well into the body of the first candle, indicating that the sellers have overcome the buyers and a potential reversal of the trend. The size and color of the candles are crucial for identifying the evening star. The first candle should be a large green one, followed by a smaller candle of any color that gaps up from the first candle, and finally, a large red candle that closes within the body of the first candle. The pattern indicates a shift in market sentiment from bullish to bearish, forecasting a potential downturn in prices. The importance of the pattern's position at the end of an uptrend cannot be overstated for accurate interpretation. The evening star pattern is considered a significant indicator for a bearish reversal only if it occurs after a prolonged or significant uptrend. This context verifies that there was a real shift in market sentiment rather than a temporary pullback in an ongoing bull market. To demonstrate real instances of the evening star patterns in different market conditions, one can look at historical price charts of various securities. For instance, examining the price chart of a stock that experienced a robust uptrend, one might observe a period where the stock prices significantly increased, followed by the appearance of an evening star pattern. This pattern would consist of a large green candle, indicating a strong buying day, followed by a small candle that gapped up from the previous close, and a large red candle that closed at least halfway down the body of the first candle. Observing the price action following this pattern would often reveal a trend reversal, with prices moving downward. While specifics like dates and stock names are not provided here, many charting software and financial websites allow investors to view historical price data, making it possible to find examples of the evening star pattern in practice. Understanding the evening star pattern with its specific characteristics and the critical context of its appearance helps traders and investors anticipate potential market reversals, enhancing their market analysis and decision-making processes. The evening star pattern in technical analysis is a strong indicator of a shift in market sentiment from bullish to bearish. This pattern typically forms at the peak of an uptrend, signaling that the upward momentum may be weakening and a potential reversal to a downtrend could be imminent. Here is how the pattern suggests this change. First, during an uptrend, a long bullish candlestick occurs, which shows that buyers are firmly in control, pushing prices higher. This aligns with a strong positive sentiment in the market. The next session opens higher, possibly creating a gap up, and forms a smaller candle or a star. This small candle represents indecision in the market. It indicates that the buyers are losing their grip and that the bullish momentum is fading. At this point, traders are starting to show caution, reflecting a mixed sentiment where neither bulls nor bears have clear control. Following this, the third session presents a long bearish candlestick that closes well into the body of the first day's candle. This demonstrates that sellers have overwhelmed buyers, pushing the price down significantly. It shows a strong shift in sentiment from bullish to bearish, signaling that traders are now expecting a downward movement in price and potentially a larger trend reversal. The evening star pattern captures a critical moment in trader psychology and market dynamics. Initially, traders are highly bullish, reflected in a strong upward move. However, the emergence of the pattern reveals growing doubts and a loss of momentum among buyers. Finally, when the bearish candle forms, it confirms a shift towards a bearish outlook among traders. This change often results in a self-reinforcing effect where the expectation of lower prices leads to selling, which in turn drives prices down further, validating the bearish sentiment. Understanding this pattern and the change in sentiment it signifies can be crucial for traders and investors, providing insights into when it might be wise to adjust their strategies in anticipation of a potential market downturn. The evening star pattern is typically seen as indicative of a potential reversal rather than a trend continuation in market analysis. This pattern emerges in a market context where an established uptrend exists. It is characterized by a sequence of 3 candlesticks. A long bullish candle followed by a short-bodied candle that gaps above the close of the previous session, and completed by a long bearish candle that closes well into the body of the first candle. To visualize this, imagine a chart where, after a period of rising prices indicated by long green candles, there appears a small candle, it could be green or red, which does not extend the trend but rather opens a space above the prior close. This gap suggests a pause in buying enthusiasm. Following this, a large red candle appears, closing within the body of the first candle, signaling that sellers are taking over and a potential downward trend could be imminent. This pattern is important because it serves as a warning to investors about a possible shift in momentum from bullish to bearish sentiment. The strength and reliability of an evening star pattern as a reversal signal often depend on the preceding market context and the volume during the formation of the pattern. An evening star after a strong uptrend, particularly with increasing volume on the third candle, suggests a stronger signal. However, the importance of context cannot be overstated. For instance, if an evening star pattern forms but follows with indecisive market movement or is situated near a strong support level that does not break, the expected reversal might not materialize. This emphasizes why traders should consider other indicators and the broader market environment before making trading decisions based on the pattern alone. In summary, the evening star is generally seen as an indication of a potential reversal in an uptrend, signaling that bears may be gaining strength. However, its effectiveness is highly influenced by the market context and accompanying trade volume, making it vital for traders to look for confirmatory signals before acting on this pattern. To fully grasp the implications of an evening star pattern in technical analysis, it is essential to consider additional indicators and conditions that can either strengthen or weaken its bearish reversal signal. One key factor is trading volume. An increase in trading volume on the day the evening star pattern is completed, particularly if this volume surge happens during the third day of the pattern, lends significant credibility to the bearish reversal signal. This is because higher volume suggests a strong consensus among traders about the impending direction change in the market. Another critical element to evaluate is the presence of nearby resistance levels. If the evening star pattern forms near a significant resistance level, this reinforces the likelihood of a bearish reversal. Resistance levels act as ceilings where selling pressure overcomes buying pressure, preventing prices from rising further. The conjunction of an evening star pattern with these resistance levels can highlight a strong barrier to upward price movements, making a downward turn more probable. The trend preceding the pattern also plays a pivotal role in the analysis. Ideally, the evening star should emerge after a pronounced uptrend, as it is a bearish reversal pattern. Its appearance after a steady increase in prices signals that the bullish momentum is potentially faltering, setting the stage for a reversal. If the pattern emerges in a different context, such as during a downtrend or a sideways market, its significance as a reversal indicator might be substantially weakened. In summary, while the evening star pattern itself is a powerful tool in predicting bearish reversals, its predictive accuracy improves when corroborated by high trading volume, proximity to established resistance levels, and its emergence after a robust uptrend. Considering these additional factors can provide a more nuanced and reliable analysis, helping traders make more informed decisions. The evening star pattern is recognized as a bearish reversal indicator that often signals a shift from a bullish to a bearish market trend. It is characterized by a small-bodied candle that opens above the previous day's close, followed by a candle that closes well into the body of the first candle in the series, reflecting a reversal in market sentiment. Historically, the evening star pattern has demonstrated a notable degree of accuracy in forecasting market direction changes, particularly in environments where buyers begin to lose control and sellers start to dominate. However, it is crucial to acknowledge the limitations of relying solely on this pattern for making investment decisions. The financial markets are influenced by a myriad of factors, including economic indicators, geopolitical events, and market sentiment, which can all affect the reliability of technical patterns like the evening star. Therefore, investors and analysts often emphasize the importance of corroborating the signals provided by the evening star pattern with other analytical tools. These may include moving averages, momentum oscillators, or volume analysis, which can collectively offer a more holistic view of the market and enhance the accuracy of trend predictions. In conclusion, while the evening star pattern can be a valuable tool in the technical analyst's repertoire, its effectiveness is maximized when used in conjunction with other analytical techniques. This approach helps mitigate risks associated with over-reliance on a single indicator and ensures a more robust and informed investment decision-making process. Integrating the evening star pattern, a bearish reversal indicator, with other technical analysis tools such as the Relative Strength Index (RSI), Moving Average Convergence Divergence (MACD), or Fibonacci retracements can enhance trading decisions by providing a multi-dimensional view of the market. Here is how these tools can be combined effectively. Combining with RSI. The Relative Strength Index measures the velocity and magnitude of directional price movements. An evening star pattern forming when the RSI is above 70 might indicate an overbought market condition, suggesting a potential reversal. This combination offers a stronger signal for a bearish reversal than the evening star pattern alone. Integrating with MACD. The moving average convergence divergence is a trend following momentum indicator. If the MACD line crosses below the signal line around the same time an evening star pattern appears, it confirms the bearish momentum, strengthening the decision to consider a sell or short position. Using with Fibonacci retracements. Fibonacci retracements identify potential support or resistance levels. If an evening star pattern emerges near a key Fibonacci retracement level, such as 618, it could indicate a reversal from a previous bullish trend. This placement provides an additional layer of confirmation for the reversal indicated by the evening star pattern. Real-world example. Imagine a stock that has been in a strong uptrend showing an evening star pattern on the daily chart. If this pattern forms at a significant Fibonacci retracement level, say the 618 level, and coincides with the RSI being above 70, it indicates overbought conditions. Further confirmation is provided if the MACD line crosses below the signal line around this time. Traders combining these signals might see a high probability setup for a bearish reversal, leading to decisions like selling their stocks or entering short positions. This multi-layered approach leverages the strength of each indicator, significantly improving the reliability of trading decisions based on the identification of potential market reversals. The evening star pattern is a bearish reversal indicator that appears at the top of an uptrend, signaling a potential shift to a downtrend. Recognizing and interpreting this pattern accurately is crucial for traders aiming to make informed decisions. However, there are common mistakes and misconceptions that can lead to incorrect interpretations and trading decisions. One of the main errors traders make is acting on the evening star pattern without waiting for confirmation. This pattern is typically confirmed by a subsequent bearish candlestick that closes below the body of the first candle in the pattern. Acting without this confirmation can result in premature and potentially misguided trades. Another mistake is confusing the evening star with similar patterns, such as the doji star. While both indicate potential reversals, their formations and implications are different. The evening star pattern involves 3 candlesticks with a clear long bearish candle as the third, while a doji star includes a doji candlestick, which is characterized by its small body indicating indecision in the market. To avoid these mistakes and improve pattern recognition and analytical skills, traders should 1. Enhance their knowledge of candlestick patterns. Familiarize themselves with various candlestick formations and their market implications. This broad knowledge base helps in correctly identifying specific patterns such as the evening star. 2. Practice patience. Wait for complete pattern formation and confirmation before making trading decisions. This reduces the risk of acting on incomplete or misleading signals. 3. Use technical analysis tools. Incorporate other technical indicators and analysis tools to confirm the signals provided by the evening star pattern. This could include trend lines, moving averages, and volume analysis, which help to validate the potential reversal signaled by the pattern. 4. Gain real-world experience. Apply knowledge in practical, real-world scenarios through paper trading or small, controlled trades. This hands-on experience is invaluable in refining pattern recognition and analytical skills. By understanding common mistakes and actively working to avoid them, traders can more effectively harness the evening star pattern as part of a comprehensive trading strategy. The evening star pattern serves as a critical indicator for traders aiming to make informed decisions about setting entry and exit points in their trading strategies. This pattern, observed in candlestick charts, signals a potential reversal from a bullish to a bearish market trend. To employ the evening star in setting entry points, traders should look for this pattern to appear after a sustained uptrend. The appearance of the evening star, which includes a small-bodied candle between two larger candles, the first being bullish and the last being bearish, suggests that the bullish momentum is waning and a reversal is imminent. At this point, traders might consider preparing to enter sell positions as soon as the pattern is confirmed by a subsequent bearish candle. This approach relies on the assumption that the appearance of the evening star will precede a drop in prices. For setting exit points for existing long positions, the identification of an evening star pattern can serve as a signal to close out positions to capture gains before a potential decline. Traders utilizing this strategy aim to minimize losses or lock in profits by responding quickly to the bearish signal provided by the evening star. One case study involved a trader who closely monitored tech stocks for patterns indicative of market reversals. Upon observing an evening star pattern in the candlestick chart of a leading tech company following a period of significant growth, the trader decided to sell short. This decision was based on the belief that the stock was about to experience a decline. In the days that followed, as predicted by the evening star pattern, the stock price began to fall, allowing the trader to buy back the shares at a lower price, thus realizing a profit from the position. This example illustrates how recognition of the evening star pattern, combined with timely action, can contribute to successful trading strategies by capitalizing on anticipated market downturns. Overall, the evening star pattern is a valuable tool for traders. By providing early warning signs of a potential bearish reversal, it helps inform both entry and exit decisions, enhancing the effectiveness of trading strategies based on pattern recognition. The evening star pattern is a bearish reversal indicator commonly spotted on candlestick charts. It serves as a crucial signal for traders to assess potential market downturns. Let's explore variations of this pattern and similar patterns, understanding how they differ and what unique implications they carry for trading. First, we have the morning star pattern, which is essentially the inverse of the evening star. While the evening star indicates a potential reversal from an uptrend to a downtrend, the morning star suggests a shift from a downtrend to an uptrend. This pattern consists of a long bearish candle, followed by a short candle or doji that gaps below the previous one, and is completed by a long bullish candle. Another variation is the doji star pattern, which can be seen as a subtype of the morning and evening star patterns. The key difference lies in the second candle, which is a doji, a candle with a very small body that indicates indecision in the market. A doji evening star is particularly seen as a stronger bearish reversal signal due to the indecision marking the end of an uptrend. The shooting star pattern is another bearish indicator, but is different from the evening star in its formation. It includes a single candle with a small lower body, a long upper wick, and little to no lower wick. This pattern indicates a failed rally and suggests that sellers are beginning to take control after an uptrend. Finally, the bearish engulfing pattern, while not a variation of the evening star, shares similar bearish reversal implications. It consists of two candles where a large bearish candle completely engulfs the preceding small bullish candle. This pattern indicates that bears have overtaken the bulls, often leading to a trend reversal from bullish to bearish. In trading, recognizing these patterns and their variations is essential. Each carries unique signals about market sentiment and potential shifts in price movement. For instance, while the evening star warns of an upcoming downturn, and after a period of bullishness, the morning star suggests optimism and a potential bullish recovery. Understanding these nuances allows traders to make more informed decisions, potentially leading to better outcomes in their trading strategies.